Welcome back to the deep dive. So you've handed us this amazing challenge. We're taking two huge, widely followed U.S. companies, Adobe and Lululemon, and we're running them through the super investor gauntlet.
Yeah, we're talking the really high standards set by legends like Buffett, Munger, Dalio, and Marx.
Exactly, and these companies couldn't be more different. On one hand, you have Adobe, the digital software titan.
With, what, 21.5 billion in revenue?
And on the other, Lululemon, the premium apparel powerhouse with around $10.6 billion.
Right, and the whole point of this exercise is to strip away that sector bias. We're not asking if tech is better than retail. We're asking purely which one is the higher quality business at a better price according to these very, very stringent checklists.
Okay, so let's get into it. And I think we have to start where all the greats do. The qualitative stuff, the business models, and more importantly, the moats. What really protects these companies?
Let's start with the software fortress then. Adobe, ticker ADBE. Their model is just beautiful, really. It's all cloud-based, all subscription revenue.
The Creative Cloud, the Document Cloud.
Exactly. Photoshop, Acrobat, and then the Experience Cloud for their big enterprise clients. That kind of predictable recurring revenue is, it's the holy grail for investors.
And that moat seems incredibly durable. The sources we looked at really hammered two things: high switching costs and network effects. I mean, if you're a creative studio, moving off of Creative Cloud it's not a simple software update. It's your entire workflow. Years of saved assets and training.
It would be a logistical nightmare. And their products are the industry standard, so they become the default choice. But what's really interesting now is how they're reinforcing that moat with AI.
Right. It's not a passive defense anymore.
Not at all. They're actively using proprietary data, their Adobe Sensei platform. I saw this one fact that just blew me away. 99% of Fortune 100 companies are using AI inside an Adobe app.
Wow. 99%.
Yeah. That tells you they're driving the next wave, not just reacting to it.
That level of trust is powerful. But that actually brings us right to the big risk, doesn't it? If your whole moat is built on being the standard, what happens when a new technology just skips the standard altogether?
That is the critical threat. You have these generative AI companies, Sora, Midjourney, Runway ML. They're creating entirely new ways of working that, well, they sometimes just bypass Adobe's world.
So even with Adobe integrating AI, these other guys could really start to pressure their pricing power.
Or force them into a very expensive arms race just to stay on top. The whole landscape is it's changing faster than ever.
Okay, let's pivot. Let's talk Lululemon, L-U-L-U. We're going from the infinite scalability of software to the very real, very tangible world of high-end yoga pants.
It's a brand machine. They're selling athleisure through, over 760 of their own stores, plus a huge direct-to-consumer online business.
Which is over 40% of their sales, I think.
Yeah, and Lululemon's moat is built on something intangible. It's brand perception, quality, and a sense of community.
They're not just selling clothes.
No, they're selling a lifestyle. It's backed by this made-to-feel philosophy and their own proprietary fabrics like Luon.
And the proof of that moat is right there in the numbers, the pricing power. I was looking at their gross margin for fiscal 24. It was almost 59%.
Which is just incredible for apparel.
I mean, the sector average is barely over 54%. That 5-point gap, that's pure brand power. It's people willing to pay a lot more for that logo.
It is the financial signature of a great brand. And their strategy, this power of 3x2, is all about leaning into that. Product innovation, growing their men's category.
Which is already almost a quarter of their revenue.
And it's growing fast, plus massive international expansion. You just have to look at China. Mainland revenue grew 41% there last year. The brand travels.
Okay, so Adobe faces this sort of existential tech disruption risk. Lululemon's risk seems simpler, but maybe more immediate: cyclicality and competition.
That's a great way to put it. We saw that worrying sign of softness, right? Their Q2 comparable sales in the Americas were actually down 4%.
Down 4%.
When people get worried about their budgets, Lululemon feels it instantly. They're always dealing with supply chains, tariffs, and giants like Nike trying to get a piece of their pie.
That contrast is perfect. It brings us to the next section, the money metrics. Let's put these two under the super investor microscope and see how the financials really stack up.
All right. Let's start with the big one, margins. The software versus apparel showdown.
Adobe's gross margin is 89%. It's
Yes.
just, it's an extraordinary number. That's pure software.
Almost zero cost to sell one more copy. Lululemon's 59% looks small next to that.
It does, but you have to keep it in context, right?
Absolutely. 59% in retail is proof of genius. But let's go further down to the net margin. Adobe's at about 26%,
And Lululemon.
17.1%, which again sounds lower, but that is 5 times more profitable than the average apparel company. Both of these are best-in-class machines.
Let's apply that Charlie Munger test of efficiency. He always hated high SG&A selling, general, and admin costs. He wanted businesses that didn't have to spend a ton just to operate.
And this is where you see a really fascinating trade-off. Adobe's core G&A costs are low, around 7% of revenue. That fits the Buffett ideal.
What?
But they have to spend a fortune on R&D to defend that moat. Almost $4 billion. That's 18% of their revenue, all going into R&D to fight off those AI competitors. It's not optional.
Okay, so how does Lululemon look on that front?
Their SG&A is higher, about 35.5%, which is technically above that 30% line some value investors like to see.
So that's a negative?
Not necessarily. That spending is what maintains their brand moat. It's the cost of their beautiful stores, their community events, their marketing. It's the cost of quality, and it's still way better than the industry average of 45%.
So they're both just spending in different buckets to defend their moats. Adobe on R&D, Lululemon on brand and experience. Okay, let's talk balance sheets. Leverage. This is huge for super investors. Now I have to ask. Adobe generated $7.8 billion in free cash flow. Lululemon, $1.6 billion. How can Lululemon even be in the same conversation?
That is the essential question. And this is where a conservative value philosophy really differs from a growth philosophy. You're right, Adobe is a cash machine.
Oh.
But they carry $7 billion in long-term debt. Their debt to equity is 0.43, and they spent $9.5 billion on buybacks last year, more than their net income.
That's a very levered confidence, you could say.
Precisely. Now, you look at Lululemon's balance sheet, they have almost $2 billion in cash, and you have to hear this, no long-term debt.
Zero.
Zero. Their current ratio is over 2. Which means spectacular liquidity. That pristine, debt-free balance sheet gives them the kind of resilience that Buffett and Munger just adore. It makes them fundamentally safer.
Wow, okay, that changes the calculation completely. It's not just how much cash you make, but how secure that cash-making ability is.
It's everything to a conservative investor. And one final quality check. Return on invested capital, or ROIC. How well does management use the money they have?
And both are good here, right?
Both are fantastic. But Lululemon actually generates higher returns.
That's surprising for a company that has to deal with physical stores and inventory.
It is the ultimate sign of just how well run that company is. Lululemon's ROE is over 42%, and its ROIC is 27%. Adobe is a little behind on both.
So Lululemon is actually more efficient with its capital.
You can argue that their ability to generate nearly 30% returns in a capital-intensive business is a greater sign of quality than Adobe's returns in an asset-light one.
That brings us perfectly to the big assessment. We've established both are high quality. Now we have to talk about price. What do you have to pay for that quality?
Because price is what determines value. And Adobe, well, it trades at a clear premium. The PE is almost 41.
And Lululemon is much lower. 27, 28 times earnings.
Right. But let's use the EV to EBITDA multiple. That's the key here because it accounts for the debt difference.
It gives you a true apples-to-apples look at the whole business.
Exactly. And even with that, Adobe is still valued significantly higher, about 27 times versus Lululemon at just 17.
So what happened? What created that gap?
Context is everything. Lululemon's stock got absolutely hammered. It fell about 50% from its peak this year because of those worries about U.S. consumer demand.
So the market panicked.
The market panicked. And that pessimism, even while the core business stayed strong, is what pushed Lululemon squarely into the value investor's strike zone.
Okay, so let's put on the different investor hats. Why would Warren Buffett and Charlie Munger lean towards Lululemon?
Oh, it's right up their alley. They love simple, predictable businesses, high returns, and most of all, that rock-solid balance sheet. They understand brands that can raise prices every year.
And Adobe's high valuation and the whole fast-moving tech thing, that's less their style.
Way less appealing. Munger especially. He would see that 50% stock drop in Lululemon and say, there it is, a wonderful company at a fair price.
That idea of buying quality when everyone else is scared, that sounds like Howard Marks or Seth Klarman.
Oh, absolutely. They're all about margin of safety. They would lean heavily toward Lululemon right now. That 50% correction is margin of safety. It's built in.
Whereas Adobe's price assumes perfection.
It demands perfection. If Adobe stumbles at all with this AI threat, the downside is huge. There is no margin of safety there.
What about Joel Greenblatt, the magic formula guy? Purely quantitative.
Greenblatt's framework would favor Lululemon, no question. It scores better on both of his key metrics, a higher ROIC, which we mentioned, and a higher earnings yield.
Which is just the inverse of the PE, essentially.
Right. Lululemon's is 3.6%, Adobe's is 2.4%. For a pure numbers guy, Lululemon is the clearer statistical choice today.
So is there anyone who would prefer Adobe? What about, say, Ray Dalio, who is all about diversification?
That's a great question. Dalio might actually argue for holding both.
Really?
Yeah, he wants assets that behave differently. He would see Adobe as his play on secular tech growth with those stable subscription cash flows. And he'd balance it with Lululemon, which, despite the cyclicality, gives him that strong geographic diversification with its growth in China.
That makes sense. Okay, let's bring it all together. Let's look at the most recent news and then make the final call.
Sounds good. So Adobe just had a solid quarter, Q3. They actually raised their full-year guidance, specifically because their AI features, like Firefly, are getting adopted.
So they're executing well, but they are acknowledging the competition.
They're very open about it. Lululemon, on the other hand, had more moderate growth, revenue up 7%, and they had to cut their guidance for the full year.
Citing that U.S. softness and tariffs.
Right. So one is raising guidance, the other is cutting. But when you put all this back into that super investor framework, Lululemon still comes out as the more compelling pick for a conservative value investor.
Because it's that combination of superior quality metrics, the debt-free balance sheet, the ROIC, paired with a much more attractive valuation after that big sell-off.
Exactly. Adobe is a phenomenal business, no doubt. But that 40 times PE ratio assumes flawless execution, and that the AI competition is a non-issue. The risk is just much higher at that price.
So the lesson here, really, is that a disciplined checklist can lead you to surprising places. Sometimes the premium apparel brand is actually the safer, better value than the dominant tech giant.
The market panic on LULU created the opportunity. The zero debt on its balance sheet made the security proposition just irresistible for that type of investor.
It's the classic dilemma, isn't it? A wonderful company at a premium price versus a wonderful company that's finally selling at a fair price. That's where the real money is made.
And, as we wrap up, we kept coming back to Lululemon's incredible growth in China, up 41%, which is helping to offset some of that weakness in North America.
Which leaves a really important final thought for you, the listener, to mull over. Given that Lululemon is actively managing this near-term pressure by investing so heavily in international growth, how many years will it take?
How many years? Until their rest-of-world revenue base becomes so large that it completely offsets any bumps they might face in their historically dominant North American market? It's a key question.
It's all about the diversification of that incredible moat. Something to think about.
Keep that thought with you. We'll catch you on the next deep dive.